Question 1. In a treaty reinsurance agreement, a ceding insurer transfers a portion of the risks it underwrites to the reinsurer. Which of the following best describes the key characteristic of a quota share reinsurance arrangement? A. The reinsurer assumes a percentage of every policy written by the ceding insurer, sharing both premiums and losses based on a fixed percentage. B. The reinsurer assumes a fixed dollar amount of losses per policy, regardless of the size of the policy. C. The ceding insurer retains all premium income, while the reinsurer is responsible for covering any losses exceeding a specific threshold. D. The reinsurer only assumes losses above a predetermined amount for individual policies, not a percentage of premiums or losses. Answer A. Explanation. In a quota share reinsurance arrangement, the reinsurer assumes a fixed percentage of each policy's premiums and losses. The ceding insurer retains the remaining percentage. Its structure is proportional, meaning both premium and loss sharing are done according to a set percentage. This is a key characteristic of quota share, which distinguishes it from other reinsurance types like excessive loss. Question 2. Scenario-based question. Mr. Anderson is a reinsurance broker tasked with negotiating a treaty reinsurance agreement between a regional insurer and an international reinsurer. The insurer has suffered multiple significant claims over the past 2 years, and Mr. Anderson has been asked to ensure that the treaty limits the reinsurer's exposure to these types of large losses. What should Mr. Anderson focus on while negotiating to address this concern? A. Ensuring that the reinsurer assumes an equal percentage of both small and large claims to ensure proportional sharing of risk. B. Structuring the treaty with a stop-loss arrangement to limit the reinsurer's exposure once losses exceed a specific threshold. C. Agreeing to a facultative reinsurance structure for each individual policy to address large losses on a case-by-case basis. D. Structuring the treaty with a quota share arrangement where both parties share losses proportionally regardless of the loss size. Answer B. Explanation. In this case, Mr. Anderson should focus on structuring the treaty with a stop-loss arrangement. This type of non-proportional reinsurance is designed to limit the reinsurer's exposure once the ceding insurer's losses exceed certain threshold. Stop-loss reinsurance agreement helps protect the reinsurer from catastrophic or excessively high claims. This type of arrangement is crucial for the insurer when they are facing unpredictable losses, making it the best solution in this situation. Question 3. Which of the following is true regarding the reinsurance pricing process? A. The reinsurer determines pricing solely based on the ceding insurer's historical claims data without considering broader market trends. B. Pricing for reinsurance is solely determined by the regulatory framework and is unaffected by the ceding insurer's operational performance. C. Factors influencing reinsurance pricing include both the ceding insurer's loss experience and broader market conditions, such as the supply and demand. Reinsurance capacity. D. Reinsurance pricing is fixed and does not change based on the risk profile or claims history of the ceding insurer. Answer C. Explanation. Reinsurance pricing is influenced by a range of factors, including the ceding insurer's loss experience, which reflects the insurer's claims history and risk exposure, and broader market conditions such as the supply and demand for reinsurance capacity. This dynamic approach allows reinsurers to adjust pricing according to current market conditions and the specific risks associated with each agreement. Pricing is not based on historical data or fixed, as other market factors play a significant role. Question 4. Which of the following best describes the key difference between facultative reinsurance and treaty reinsurance? A. Facultative reinsurance covers a specific risk or policy, while treaty reinsurance automatically covers all policies within the scope of the agreement. B. Facultative reinsurance applies to portfolios of policies, whereas treaty reinsurance is limited to single large risks. C. Facultative reinsurance is based on a fixed percentage of premiums and losses, while treaty reinsurance is a non-proportional agreement. D. Reinsurance is used only for catastrophic events, while treaty reinsurance applies to normal losses. Answer A. Explanation. Facultative reinsurance is purchased on a per-risk basis and covers specific risks or policies, allowing the ceding insurer to choose which risks to cede to the reinsurer. Treaty reinsurance, on the other hand, involves an agreement that automatically covers a range of policies, typically for an entire portfolio or specified categories of business. The key difference is the scope of coverage. Facultative reinsurance is more while treaty reinsurance is broader and automatic. Question 5. In a surplus share reinsurance agreement, what typically determines the amount of risk that the reinsurer assumes? A. The reinsurer assumes a fixed percentage of every policy's premium and loss, regardless of the size of the individual policy. B. The reinsurer assumes a percentage of losses only for policies exceeding a certain threshold amount, with the ceding insurer retaining the initial portion. C. The reinsurer only participates in policies with claims that exceed the total premium amount received by the ceding insurer. D. The reinsurer assumes a percentage of each policy's loss, but only for policies that are greater than the average industry policy size. Answer. B. Explanation. Surplus share reinsurance involves the reinsurer assuming a percentage of losses on policies that exceed a specific threshold, with the ceding insurer retaining the initial portion of risk. This is a form of proportional reinsurance where the reinsurer shares in the loss, but only for the excess portion above a predefined limit, making it distinct from quota share agreements where the reinsurer assumes a percentage of both premium loss for all policies. Question 6. Scenario-based question. Mr. Thomas is the chief underwriter at a regional insurance company. Due to an increase in large unexpected losses over the past few years, Mr. Thomas is looking for a way to limit the insurer's exposure to catastrophic claims without altering the terms of the original policies. What should Mr. Thomas consider implementing in his reinsurance strategy? A. A quota share reinsurance agreement to distribute all claims proportionally with the reinsurer. B. An excessive loss reinsurance agreement to limit the insurer's exposure after certain loss threshold is exceeded. C. Stop-loss reinsurance agreement to protect against the aggregate of all claims for the insurer in given year. D. Facultative reinsurance arrangement to review and negotiate terms for each individual large claim. Answer. B. Explanation. Excessive loss reinsurance is the most appropriate choice for limiting exposure to large unexpected losses, as it provides coverage for claims that exceed a specific threshold. It does not affect the terms of the original policies, but instead limits the insurer's liability once a certain loss limit is surpassed. This form of non-proportional reinsurance is designed for catastrophic events or large claims, making it the solution in this scenario. Question 7. Which of the following is a key advantage of using non-proportional reinsurance, such as excessive loss reinsurance over proportional reinsurance arrangements? A. It allows the ceding insurer to share a fixed percentage of both premiums and losses with the reinsurer, regardless of the size of the loss. B. It provides the reinsurer with an automatic share of premiums and losses based on the ceding insurer's pricing. C. It limits the reinsurer's exposure to losses above specified amount, helping the ceding insurer protect itself from catastrophic losses. D. It is less expensive than proportional reinsurance. Reinsurer does not assume any part of the premiums. Answer. C. Explanation. Non-proportional reinsurance, such as excessive loss reinsurance, is designed to limit the reinsurer's exposure to catastrophic losses by providing coverage for losses that exceed specified amount. This allows the ceding insurer to protect itself from high impact claims while the reinsurer's liability is capped. Unlike proportional reinsurance, which shares both premiums and losses based on fixed percentage non-proportional reinsurance, focuses primarily on protecting against large, unpredictable losses. Question 8. In reinsurance contracts, loss reserves are used to account for which of the following? A. The expected premiums that will be ceded to the reinsurer over the life of the contract. B. The reinsurer's estimate of future losses that will be paid out under the reinsurance agreement. C. The portion of the premium that the reinsurer will pay to the ceding insurer for assuming risk. D. The amount of profit the reinsurer expects to make from the reinsurance agreement. Answer. B. Explanation. Loss reserves are funds set aside by the reinsurer to cover the estimated future losses that will be paid out under the reinsurance agreement. These reserves are a crucial part of reinsurance accounting and help ensure that the reinsurer can meet its obligations in the event of claims. The reserves reflect the reinsurer's best estimate of the amount required to settle the future liabilities for losses incurred but not yet paid. Question 9. Which of the following is typically a primary responsibility of the reinsurance broker in a reinsurance agreement? A. To set the pricing in terms of the reinsurance contract, ensuring the ceding insurer's profitability. B. To act as an intermediary between the ceding insurer and reinsurer, facilitating negotiations and placement of reinsurance. C. To provide legal advice regarding the enforceability of reinsurance contracts. D. To manage the claims process and determine the validity of claims under the reinsurance agreement. Answer B. Explanation. A reinsurance broker serves as an intermediary between the ceding insurer and reinsurer, facilitating the negotiation, placement, and execution of reinsurance contracts. Brokers typically do not set pricing or manage claims. Instead, they help the parties reach mutually beneficial terms and ensure the reinsurance agreement is placed with an appropriate reinsurer. They also provide expertise in reinsurance deals and help navigate the complexities of the reinsurance market. Question 10. Which of the following best describes treaty reinsurance in terms of its automatic coverage? A. It automatically covers all risks underwritten by the ceding insurer within the specified scope without the need for individual approval. B. It automatically covers only the highest value policies within the ceding insurer's portfolio. C. It automatically covers policies once certain threshold of losses has been exceeded. D. It automatically covers policies based on the reinsurer's discretion and negotiations for each individual policy. Answer A. Explanation. Treaty reinsurance provides automatic coverage for all risks underwritten by the ceding insurer within the specified scope of the treaty agreement. This type of reinsurance agreement does not require individual approval for each policy as long as the policy falls within the defined terms of the treaty. Treaty reinsurance agreements are designed to offer broad, ongoing coverage, unlike facultative reinsurance, negotiated on a per-risk basis. Question 11. Which of the following is a characteristic of stop-loss reinsurance? A. It reimburses the ceding insurer for losses exceeding a fixed amount per policy. B. It provides protection to the ceding insurer for aggregate losses exceeding a certain threshold. C. It requires the reinsurer to cover a fixed percentage of premiums for each policy underwritten. D. It offers coverage for losses incurred after the expiration of the reinsurance agreement. Answer B. Explanation. Stop-loss reinsurance is designed to protect the ceding insurer from aggregate losses that exceed a predetermined amount. It is a form of non-proportional reinsurance, meaning that it only kicks in once the total loss amount surpasses a defined threshold for all policies covered under the agreement. Question 12. Which of the following would not typically be a factor in determining the pricing of facultative reinsurance? A. The ceding insurer's overall loss experience. B. The size and complexity of the risk being reinsured. C. The individual underwriting characteristics of each specific risk. D. The automatic percentage of premium to be ceded to the reinsurer. Answer D. Explanation. In facultative reinsurance, the reinsurer evaluates each risk on a case-by-case basis. The pricing is influenced by factors such as the loss history of the ceding insurer, the complexity of the risk, and individual underwriting characteristics. Unlike treaty reinsurance, which typically involves automatic cessions at a fixed percentage, facultative reinsurance is negotiated individually for each policy. Question 13. What is a key advantage of proportional reinsurance for a ceding insurer? A. It allows the ceding insurer to retain all premium income from policies underwritten. B. It provides more predictable pricing for the ceding insurer because premiums and losses are shared proportionally with the reinsurer. C. It offers protection only for catastrophic losses above a predefined threshold. D. It eliminates the need for the ceding insurer to report claims to the reinsurer. Answer B. Explanation. Proportional reinsurance, such as quota share and surplus share, provides the ceding insurer with the advantage of shared risk. This arrangement helps the ceding insurer predict its overall exposure since premiums and losses are distributed between the ceding insurer and the reinsurer based on a fixed percentage. Question 14. Which of the following is not a typical feature of fronting arrangements in reinsurance? A. A fronting arrangement allows a primary insurer to take on a large risk by passing it through to a reinsurer while maintaining the appearance of retaining the risk. B. A fronting arrangement requires the reinsurer to pay a large portion of the premium to the ceding insurer as part of the agreement. C. A fronting arrangement allows the ceding insurer to transfer most of its risk to a reinsurer but keeps a small portion of the risk on its books. Regulatory purposes. D. A fronting arrangement typically involves a high degree of regulatory oversight by insurance regulators to ensure compliance with financial solvency requirements. Answer B. Explanation. In a fronting arrangement, the primary insurer retains only a small portion of the risk for regulatory or licensing purposes, while the reinsurer assumes the bulk of the risk. However, the reinsurer does not pay a large portion of the premium to the ceding insurer. Instead, the reinsurer bears the risk while the ceding insurer benefits from regulatory compliance and maintains the appearance of coverage. Question 15. Which type of reinsurance is particularly appropriate for covering large individual risks that do not fit within a standard treaty agreement? A. Quota share reinsurance. B. Excessive loss reinsurance. C. Facultative reinsurance. D. Stop loss reinsurance. Answer. C. Explanation. Facultative reinsurance is used for individual non-standard risks that do not fit within the broader scope of a treaty agreement. Each risk is evaluated and accepted on its own merits, making it appropriate for covering large, unique, or complex individual risks. Question 16. Scenario-based question. MS. Davis is the CEO of a mid-sized insurer that has seen consistent profitability but is concerned about the impact of a potential natural disaster in the region. She is considering implementing a form of reinsurance that would protect the company in the event of a catastrophic loss. What should MS Davis consider using? A. A quota share reinsurance agreement to evenly distribute risk across multiple policies. B. A facultative reinsurance agreement to cover individual large policies that are highly exposed to natural disasters. C. Excessive loss reinsurance to limit the insurer's exposure to losses above a certain threshold. D. Surplus share reinsurance to retain more risk and share smaller losses with the reinsurer. Answer. C. Explanation. Excessive loss reinsurance is the most appropriate option for protecting against catastrophic losses, such as those from natural disasters. It limits the ceding insurer's exposure to losses above a certain threshold, making it ideal for managing catastrophic events while still retaining some risk. Question 17. Which of the following is the primary role of a reinsurer in a treaty reinsurance arrangement? A. To evaluate individual risks and negotiate specific terms for each policy. B. To automatically assume a specified portion of all risks covered under the terms of the treaty. C. To maintain sole responsibility for claims adjustment and loss management for all policies. D. To directly interact with policyholders to determine coverage and premiums. Answer. B. Explanation. In the treaty reinsurance arrangement, the reinsurer's role is to automatically assume specified portion of all risks covered by the treaty without the need for individual negotiation for each policy. This contrasts with facultative reinsurance, where the reinsurer evaluates risks on case-by-case basis. Question 18. Scenario-based question. Mr. Walker is an actuary for an insurance company that is preparing to renew its treaty reinsurance agreement. The company has experienced fewer losses than expected in the past year, and Mr. Walker wants to adjust the treaty's terms accordingly. What should Mr. Walker do? A. Adjust the excessive loss threshold to increase the insurer's exposure to losses. B. Increase the quota share percentage to retain more premium and losses within the company. C. Negotiate a low premium rate for the treaty to reflect the reduced risk and lower loss experience. D. Reduce the retention limit for the company to shift more risk to the reinsurer. Answer. C. Explanation. Given that the company has experienced fewer losses than expected, lowering the premium rate for the treaty reflects the reduced risk and would be a reasonable adjustment. This helps the insurer benefit from low premiums in line with its reduced exposure, ensuring that the reinsurance terms remain competitive and appropriate for the risk profile. Question 19. Which of the following is a key characteristic of proportional reinsurance? A. The reinsurer assumes only a portion of the claims that exceed a fixed loss threshold. B. The ceding insurer retains a fixed percentage of premiums and losses for each policy covered under the treaty. C. The reinsurer provides coverage only for large catastrophic losses exceeding a specific amount. D. The ceding insurer retains responsibility for claims adjustment and the reinsurer provides capital funding. Answer. B. Explanation. Proportional reinsurance involves the ceding insurer and the reinsurer sharing both premiums and losses according to a fixed percentage. The reinsurer does not assume responsibility for claims above a specific threshold. That would be non-proportional reinsurance, and both parties share the risk in proportion to their agreement. Question 20. In the context of loss reserves for reinsurance, which of the following best describes the role of a ceding insurer? A. The ceding insurer is responsible for maintaining reserves to cover the reinsurer's share of the claims. B. The ceding insurer maintains reserves for the total claims of the policies underwritten, including both those covered by reinsurance and those retained by the insurer. C. The ceding insurer transfers all loss reserves to the reinsurer as the reinsurer assumes full responsibility for future claims. D. The ceding insurer is not responsible for maintaining any loss reserves as all losses are covered by the reinsurer. Answer. B. Explanation. The ceding insurer is responsible for maintaining reserves for the total claims underwritten, which includes both the losses covered by the reinsurer and those retained by the insurer. The reinsurer shares in the loss, but the ceding insurer must still account for the overall liabilities in its financial statements. Question 21. Which of the following is a typical obligation of a reinsurer in a claims-made reinsurance agreement? A. To pay only for claims reported within the term of the policy. B. To cover all claims incurred during the policy period, regardless of when they are reported. C. To provide protection for claims that have been filed before the treaty's expiration date. D. To automatically settle claims with the ceding insurer on first-come, first-served basis. Answer. A. Explanation. In the claims-made reinsurance agreement, the reinsurer is typically obligated to pay for claims that are reported during the term of the policy, regardless of when the loss actually occurred. This differs from an occurrence-based agreement where the reinsurer covers losses based on when they occurred, not when they were reported. Question 22. What does the term ceding commission refer to in a reinsurance arrangement? A. The percentage of premiums paid to the reinsurer to cover their operational costs. B. The amount of premium the ceding insurer retains after the reinsurance arrangement is in place. C. The commission paid by the reinsurer to the ceding insurer to cover acquisition costs and administrative expenses. D. The portion of the premium that is returned to the reinsurer in the event of claims below expectations. Answer. C. Explanation. A ceding commission is paid by the reinsurer to the ceding insurer to cover the acquisition costs and administrative expenses incurred by the ceding insurer in writing the policies that are reinsured. This commission helps offset the costs involved in underwriting and managing the policies. Question 23. Which of the following would typically be excluded from a reinsurance treaty? A. Claims that arise from accidental property damage. B. Claims resulting from high-frequency, low-severity events. C. Claims for losses below the retention limit specified in the treaty. D. Claims related to reinsurance agreements with non-participating reinsurers. Answer. C. Explanation. Claims for losses below the retention limit specified in the treaty would typically be excluded from reinsurance coverage, as these losses are retained by the ceding insurer. Reinsurance treaties generally only cover losses that exceed a predetermined threshold retention limit. Question 24. What is the main purpose of a retrocession in the context of reinsurance? A. To transfer the risk of a reinsured policy back to the ceding insurer. B. To reduce the reinsurer's exposure by passing the risk to another reinsurer. C. To adjust the terms of the original reinsurance treaty. D. To offer additional coverage to policyholders who exceed their original policy limits. Answer. B. Explanation. Retrocession involves the transfer of risk from one reinsurer to another reinsurer, reducing the reinsurer's exposure to large claims. This allows the original reinsurer to manage its risk by sharing some of the exposure with other reinsurers. Question 25. Which of the following is the primary benefit of retrospective rating in a reinsurance agreement? A. It provides the ceding insurer with a fixed premium amount regardless of the claims experience. B. It allows the reinsurer to adjust the premium based on the actual loss experienced during the policy term. C. It guarantees the ceding insurer full reimbursement for all claims incurred under the treaty. D. It reduces the reinsurer's involvement in claims management for the policyholders. Answer. B. Explanation. Retrospective rating allows the premium to be adjusted based on the actual loss experience over the course of the policy period. This provides more flexibility and aligns the premium with the risk exposure as it becomes clear, which helps the ceding insurer and reinsurer share the risk more appropriately. Question 26. Which of the following is a key difference between proportional reinsurance and excessive loss reinsurance? A. Proportional reinsurance provides coverage only for catastrophic losses, while excessive loss provides coverage for smaller claims. B. Proportional reinsurance involves sharing both premiums and losses in a fixed percentage, while excessive loss only covers losses above a certain threshold. C. Proportional reinsurance is applicable to specific individual policies, while excessive loss applies to overall portfolio losses. D. Proportional reinsurance requires the reinsurer to assume all losses, while excessive loss allows the ceding insurer to retain part of the risk. Answer B. Explanation. The key difference between proportional reinsurance and excessive loss reinsurance is that proportional reinsurance involves sharing premiums and losses in a fixed percentage, while excessive loss only covers losses above a certain threshold. In proportional reinsurance, the reinsurer takes a percentage of both the premium and losses, whereas in excessive loss, the reinsurer only covers losses that exceed a specified amount. Question 27. What does the term retention limit refer to in reinsurance agreements? A. The maximum amount of claims that can be ceded to the reinsurer. B. The portion of losses that the ceding insurer retains before the reinsurer becomes liable. C. The limit on how much premium the ceding insurer can charge policyholders. D. The maximum amount of capital the reinsurer is willing to accept from the ceding insurer. Answer B. Explanation. The retention limit refers to the amount of risk or loss that the ceding insurer retains before the reinsurer becomes liable. It sets the threshold above which the reinsurer assumes responsibility for losses. Question 20. Which of the following is an example of a non-proportional reinsurance arrangement? A. Quota share reinsurance. B. Surplus share reinsurance. C. Excessive loss reinsurance. D. Facultative reinsurance. Answer C. Explanation. Excessive loss reinsurance is a non-proportional reinsurance arrangement where the reinsurer only covers losses above a certain threshold rather than sharing a fixed percentage of premiums and losses like in proportional reinsurance. This form of reinsurance is often used for catastrophic or large individual risks. Question 29. In reinsurance agreements, which of the following is a common reason why a ceding insurer would seek excessive loss reinsurance? A. To share risk proportionally with the reinsurer for every policy underwritten. B. To cover catastrophic losses that exceed a specified retention amount. C. To adjust the premium rate based on the loss experience of individual policies. D. To establish a fixed premium amount for policies regardless of the risk. Answer B. Explanation. Excessive loss reinsurance is typically used to cover catastrophic losses that exceed a specified retention amount. It protects the ceding insurer from large unexpected losses while allowing them to retain smaller, more manageable risks. Question 30. Which of the following is true about the claims-made basis of reinsurance? A. Coverage applies to losses occurring during the policy period regardless of when the claim is reported. B. Coverage applies to claims reported during the policy period regardless of when the loss occurred. C. It requires the insurer to report claims within 60 days of occurrence. D. It is more favorable to the reinsurer than the occurrence-based method. Answer B. Explanation. Claims-made reinsurance applies to claims that are reported during the policy period regardless of when the loss occurred. This contrasts with the occurrence-based method where coverage applies to losses occurring during the policy period regardless of when the claim is reported.